Geopolitical developments are on the minds of many folks. What is your interpretation of the market reaction and impact of the conflict in the Middle East? And also, how are you as an investment team dealing with it?
Thanks, Andrew. The forward curve has oil trading of nearly $80 through year end, so just 25% since the conflict started. So it is more concerned than the equity market, which is only off about five. The Strait of Hormuz has a flow of oil of about 20 million barrels, and that's been cut in half, net of sort of workarounds and whatnot. So there's still 10 million barrels missing from the market, which is nearly 10% of global demand. And Iran looks increasingly like it is digging in and trying to use mines and drones to um, disrupt the strait for a longer period of time than we had thought. So if we don't see Hormuz back to sort of full capacity by the end of April, some of the experts are saying that we could see oil above 120, and that becomes a major problem for the global economy. I mean, my personal guess is that we will probably see some recovery in shipping. We probably don't recover the full 10 million. So, I mean, I imagine oil could end up staying elevated, maybe in the 90 to $100 range for the rest of the year. Um, and that would still be a significant disruption. Further, oil products such as jet fuel and diesel are also being disrupted. I think people also don't realize natural gas is a major export from that part of the world, and that is potentially an even larger impact. Qatar has had a significant shut-in of natural gas production recently due to attacks on their infrastructure that could put them out for several months. It's going to take time to bring that back, and that is a bigger problem for Europe, for Asia especially, and any other gas importing nation. And the U.S., of course, is an exporter, so our domestic prices are insulated. But this is still a big boost to global inflation and a headwind for the global economy. I would say that one unintended consequence is that other commodities that go through the strait are also being disrupted, especially aluminum and fertilizers. So, about 10% of global supply of aluminum has been disrupted through the strait, 30% of global ammonia, and nearly 50% of global urea exports go through the Strait of Hormuz and have been disrupted. So there's there's a real risk of inflation could be broadening out into other areas than just energy if the volumes of these other commodities do not get uh, put back to full capacity. So my biggest concern really is that you've got energy, you've got fertilizer, you've got metals, all of which are rippling through in terms of prices, and that could drive a above, say, I don't know, 5% inflation headline, going through the year end, and that then turns out not to be transitory. Uh, the U.S. is somewhat insulated. All right, we are a exporter of energy, self-sufficient, um, but still the consumer gets hit pretty hard. Right, gas prices are already nearly $4. So energy producing states, right, in the United States are about 15% of GDP. So it's an unequal distribution of who benefits versus who gets hurt. The Fed can only look through if core inflation remains below 3%, which it is not yet. So I am cautious about the Fed's ability to cut in the face of economic weakness if that's what happens. Now, the good news is U.S. Equity and credit markets, they are taking their cue from the forward oil curve. US equity and credit markets are viewing this as a short term issue. Now, if they're right, that's fine. Everything goes back to normal. But it is a bit risky at 23 times forward earnings and with tight credit spreads relative to history. A potentially nonlinear rise in oil, which is the risk that we face, could then cause a nonlinear hit to corporate earnings, which then would cause a nonlinear sell off in equities and credit. I'm not making a prediction. I'm just pointing out that that is a risk that does not appear to be priced into today's equity and credit markets. So the good news is that consumer and corporate tax cuts are providing tailwinds to growth in the US as we enter this year. And that does offer the US some cushion. Similarly, Europe's fiscal spending on defense, on reshoring, and on competitiveness is also likely to offer some cushion to their economic growth. Not to mention Japan, which is now looking also at passing a large fiscal stimulus package. So the developed economies might be able to ride this out without too much disruption. Obviously, there's a ton of certainty around that statement. The flip side of growth holding up that one has to be mindful of is that if the global economy remains okay, it's more likely that inflation works its way through into wages, which is a catch-22 for markets and central banks. So, in times of extreme uncertainty, as we are in now, our approach is to maintain healthy reserves of purchasing power in the form of cash, but also gold, so that in the event of a major market dislocation or disruption, we can take advantage of that situation and play offense while others are playing defense.
Some of the disruptions that you mentioned have had a major impact on asset class returns, in that there's been reversals from what was working at the start of the year to now what's working post conflict. One of those beneficiaries has been the US dollar. Can you talk about your view on the US dollar? Has there been a secular change in its outlook based on this?
Well, I think one has to think about this in two ways. All right. Short term, you definitely are seeing this risk off moment, a flight to the dollar, back to a US centric investment world, as the US is comparatively more insulated than EU and Asia. But longer term, the US decision to attack Iran, I think, is reinforcing the perception of the US as an unpredictable and unreliable ally. And that could cause foreign investors to eventually gradually redirect investment flows away from funding US deficits and buying US treasuries to funding their own rising deficits. And we talked before about how the math on that has become more favorable of keeping their money home. And that risks tightening financial conditions in the US. So tightening that would need to be countered by the Fed. And they can do it directly through QE or indirectly by cutting short rates, steepening the curve, and then inducing US banks to buy treasuries and ride the curve. Either one, however, would likely result in a weaker dollar. And as I never tire of reminding clients, this is one of the goals of the administration as they try to shrink the trade deficit. So the US dollar is still a safe haven during these moments of crisis. On the other hand, our foreign policy decisions on tariffs, but also on Greenland and obviously on Iran, might be turning foreign investors away from wanting to fund our deficits and supporting the dollar. And only time will tell. But either way, when you think about how we approach those risks, we just remain focused on trying to use any dislocations that geopolitics might create to find resilient businesses trading at large discounts to what we think they're worth and owning them for the long term.
Thanks for your thoughts, Adrian. Look forward to speaking to you next time.
Thank you.